Welcome back to another stock market open live stream. Today we have some catalysts to talk about. Finally, a little bit of entertainment in the market. I love myself some entertainment. You've got Tesla deliveries coming up. Then you've got the JOLTS data coming up. And then you've got some more pricing reads. Well, we're going to go through them all. So today's first big thing everybody's going to be paying attention to, I believe, are going to be those Tesla deliveries. You've already got the Tesla delivery numbers coming out of China, and those numbers are suggesting a little bit of weakness going forward and backwards, which isn't great. So Tesla stock, as a result, is down about 1.5% in the pre-market, but nothing dramatic. I mean, the thing was up 6% yesterday, so who cares? And the trend is clearly up. You know, we've really bottomed out over here, so the delivery numbers don't matter too much. Much like we talked about in the video yesterday, I think you almost kind of want a bad delivery number so you can go pick up a little bit more before earnings and before you really move forward. With some more, how should I say, your local options. But anyway, yeah, it was the Tesla shipments expected to slump by 24.2% year over year in China, as Tesla China June deliveries came in at 71,000. We don't have the U.S. numbers yet. Expecting those to come out, quite frankly, anytime within about maybe the next 30 minutes or so. So as those come out, we'll cover those. We've got those handy and dandy, ready to go. So we are looking for those. As we wait for those, we will also take a peek at some of the other numbers, including JOLTS, which we're looking for actually a seven handle. Well, the last read we got was 8,059,000, and this time we're looking for 7.946 million. So the first time we're going to be getting a 7 handle on JOLTS, at least per expectations. Probably if you're playing options, you know, what you don't want is a number that's so low that it's recessionary. Like, you don't want it to be like a 6 handle. And you probably don't want something over 8.5. So I'd probably say a good range is somewhere between 7.5 and 8.5 would be relatively optimistic. Although the more hot, the more bearish for rates. So really, if you want to be bullish on rates, you're probably looking at something like 7.7 would be ideal, somewhere around there. Okay, so then we got BTCs over here. You've a nice little Weeble gap in data there. But anyway, one of the things that you've got is this double rejection over here at the 63.82.1 line. This is a pretty interesting double rejection here, because you saw this happen in the market yesterday. Midday, roughly, we saw this, rotate straight down after getting rejected, and didn't actually see a lot of stocks follow it. So some folks think that today you could have a red day in markets, just as BTC is foreshadowing a little bit of pain. On top of that, we have the yield curve. 10-year Treasury yield is actually down about 3.7 basis points right now. So a little bit of softening in that the higher yields that we saw yesterday, and that yield curve steepening has slowed a little bit. We're on about day 7 of steepening, and it's flat right now for the last 24 hours. So we'll see what that ends up meaning for the broader market. Some bullishness. So we are now just on standby for some delicious numbers to actually come on through. Let's take a peek at some other things that we can cover in the meantime, like a very popular... Nope, never mind. Okay. So, let's see what the suits are up to today. Oh, the suits. What have you for us today? Let's find out. S&P's deteriorating breadth signals rally could be fading. Ooh, bearish headline. That's the first thing the suits want to open with this morning. You dirty bastards. Okay, I shouldn't say that. But anyway, it's just nice when things are skyrocketing, because you just buy YOLO calls and spray and pray. You know, I mean, isn't that how everybody plays shooters anyway? Just hold down the trigger. Okay, so let's see here. All right. Oh, yes. Okay, let me get this. There we go. Haha. All right. Who here is freaking out because of Trump's immunity? Are you afraid to walk outside because you think you're gonna get shot now? And then someone's gonna get away with it with immunity? I know some people are. I see it. I see the fears. There we go. I don't know why that was so hard and took so long. There, I made that little adjustment. All right, that was annoying. Okay, so where were we? Okay, so declining breadth, potentially signaling a down market to come. U.S. stocks have been resilient as tech stocks spurred a 15% rally in the S&P 500. And optimism led by AI and more potential for the Fed to ease. But now, concerns about the U.S. economy are gaining traction as we begin to see more signs of slowing. Interesting. Wide-ranging economic data illustrates a downshift in the U.S. growth over the first half of the year, tied to both the Federal Reserve's higher for longer borrowing costs, policy, and string of lingering inflation. Okay, fine. So let's take a look at these indicators here. We got personal consumption up 1.5% versus the 3.3 of the prior period. Core capital good orders negative 0.6 versus 0.3 positive. Core capital good shipments negative 0.5 versus the 0.4. These are all month over month. Change in pending home sales negative 2.1. Last was negative 7.7 though. Continuing jobless claims 1.84 over the 1.82. Merchandise trade balance also more negative. And Atlanta Fed's GDP now forecast has been coming in lower and lower and lower. That's interesting. That's a good little summary of some of the weakening. Oh, wow. Well, the latest GDP now estimate puts us at 1.7. Yikes. Let me show you that one. That's a juiced chart right there. Look at that chart. Somebody says I have hoodie lint on my shirt. But it's by design, bro. It's by design. It's a feature. Is it this? This tiny little thingy? That's what you're worried about? Whatever. So anyway, you want it to be more pure red, huh? Huh. Oh, you know what? There's like a down feather on me. That's crazy. Does anybody else like sleeping with like the comfy down pillows? I think now the environmentalists are gonna come after me. Be like, how dare you? We were okay with the plane, but down pillows? Now we're gonna kill you. I don't know. Okay. Anyway, this is a pretty big movement down here. Still there, bro. You know what? I'm gonna just take it off, and then we're gonna turn this into an OnlyFans page. So, it's a pretty big decline over here. Look at this. The GDP Now model estimate for real GDP growth in the second quarter is 1.7% on July 1st, down from 2.2 on June 28th, following ISM figures. And second quarter PCE expenditures growth, and second quarter real gross private domestic growth decreasing. Wow. Yeah, look at that. That's a gnarly decline. All right, let's listen in here for a moment.
Begins July the 9th.
Why do they talk about Rust on Fox Business? You know, listen, everybody's always worried about Alec Baldwin and how you're going to get shot if you're around Alec Baldwin. Look, the answer here is simple, folks. I will always stand behind Alec Baldwin.
The donations and the big headline that just came out last night and this morning about how many donations were made in the aftermath of the debate and saying, this is our guy. My question to you is, from the donor class perspective, to the degree you think it has any influence over the future nominee, do you believe that there's a crowd of people that are going to this president and saying, we're not giving you money, we're not voting for you? What's going to happen here?
I know there is. There is a bunch of donors that are furious, that are trying to use all their levers of pressure they can. Listen, it's interesting. People isolate themselves. It's his wife. It's a small group of people around him. It's time for Hakeem Jeffries and Chuck Schumer and other senior Democrats to start speaking out and putting pressure on him, because otherwise we're going to lose. It doesn't feel like a smart strategy when 72% of the American public says we think you're too old to run for president. That's not 72% of Republicans. It's 72% of the electoral base.
So, Mike, were you just willing to go along with it before Thursday, or?
No, Joe, I have been.
Okay, you haven't wanted him for a while, but you've been giving money to him.
I have not given Joe Biden any money on this in this 4 years. I gave him money last time, and I've given money to other. Listen, this term I've given money to Democrats and Republicans, right? I mean, I need to support the crypto industry as well as the rest of my beliefs.
That's what I was going to go with it. As a guy in the crypto business, one of the things that's been fascinating is to see former President Trump come out quite publicly as an advocate for crypto regulation, and all sorts of things, even in the past couple months. Has that switched your view of him?
Get with the program. Get with the program. You're a businessman. You're a businessman.
Mike.
I'm not a single issue voter, and I do fundamentally believe crypto should be bipartisan and needs to be bipartisan. We can't have one party that likes us and the other party that doesn't. And I would tell you that most Democrats, outside of Elizabeth Warren and a small group of people, are pretty pro-innovation and pro-crypto. And so it's been unbelievably frustrating. That said, that's all shifting. And you can listen, no matter who wins the next election, we're going to get positive crypto legislation. I know that.
When you look at where things stand right now with Bitcoin ETFs, we've shown now a video of Peter Thiel, who was an outspoken bull on Bitcoin for quite some time last week when I spoke to him in Aspen. He suggested maybe this is sort of a range of where things are. Now, of course, he got in a lot earlier, but I'm curious your reaction to that.
Listen, I said this last time I was on your show. I think we were going to be in a 55-73 range until we got some new news. It takes a while.
Yeah, Thiel basically saying a lot of the current movement for Bitcoin already priced in.
Stop spending like drunken sailors. And I've never seen Donald Trump want to balance a budget. He grew government spending just as wildly as Joe Biden. I mean, these have been the two worst presidents in terms of increasing debt in the history of our country. And we still have populism on both sides. Until that changes, Bitcoin as a core holding makes all the sense in the world to me.
How's Bojangles doing? We always ask you about that. So many restaurant chains they're closing, Mike. I mean, are wage pressures getting to you yet, or inflation pressures?
It hasn't. COVID actually was an interesting time for restaurants because so many people switched to drive-through, and that's changed the dynamic of all these quick serve restaurants. But it's growing well. It's adding stores. Sales were up. EBITDA is up, and so haven't seen the. Again, where we are, you haven't seen the California minimum wage stuff, right?
Yeah,
or North Carolina,
right.
Georgia, South Carolina, and so haven't seen the same impact.
I love fast food.
Mike, more broadly, in terms of how you think this market, the sort of macro piece of it, where you think we really are, where you think we're going, how the election will affect that. By the way, how the elections in Europe may affect all of this.
Yeah, listen, it's a scary time for the world, right? I mean, we literally lost the center in France. We're losing the center everywhere.
Well, that's partly because of immigration. That's what's happening in Germany. That's what's happening in France. To some extent, that's what's happening in the United States. People are frustrated with miserable, immigration and open border policies.
Really rattling what had been a status quo for years. And it makes investing more difficult. right? Most macro guys aren't having a great year. It's interesting. And you would have thought there's so much happening in macro they would be, right? The economy's stayed stronger longer than people thought it would. In my mind, that's a lot because of all the government money that keeps getting poured in. And so I do think we're starting to see the economy slow down slowly here in the U.S. The Fed probably ends up cutting rates. I think the small leadership in stocks isn't over, right? That great markets end with less and less and less leadership, and we're seeing that. And I don't know where it stops. It could go a lot further. That's how great markets end, right? And so the story around AI is so powerful. You might see the next 6 months, 9 months, the same 5 stocks you keep talking about. And so it's a harder time to invest than most. Equities look like the yield curve looks like it's finally starting to steepen. Currencies have been more difficult. And so, sometimes there's clarity in what you see.
Oh, okay, this is boring. So, I was just finding a little bit that some economists worry that if this Friday we end up getting an unemployment read that is higher than 4%, we might end up with a triggering of that good old SAM rule, which some economists modify a little bit, so it sort of depends on who you're talking to. But that would potentially lead to a negative, what's it called, S&P 500 return in the next month. That's the warning, is that you basically have a market fall the next month as markets start pricing in recession. Oh, that sneezes always come out of nowhere. All right, so that'll be interesting. Like I said, entertainment always guaranteed. Alrighty, so anyway, still waiting any moment here for those Tesla deliveries. We're presumably within 15 minutes here of those. Again, that Tesla China June deliveries figure comes in at a negative 24.2% year-over-year decline. And now we're waiting for the Tesla US deliveries for Q2. Mind you, the consensus is somewhere between. I mean, I've seen estimates all over, so I'll put range of consensus somewhere between 422 to like 430, 440, somewhere around there. All right, let's listen in here.
Field, stay tuned. You're watching Squawk Box on CNBC.
Nope. Let's flip it. Flip to here.
Academic espionage. And so we need to make sure that we detect this whenever possible and prevent the Chinese Communist Party from converting these individuals or harassing them or intimidating them into becoming spies against the United States.
Yes, the CCP is converting our college students. They could be right.
At a moment where the Fed is considering dialing it back. So I do think that to some extent, this is a reminder that loads and supply and demand do matter in the Treasury market, but only within the context of the prevailing range. Keep in mind, 10-year yields are still below 450. And this in an environment where the real economy still appears to be on strong footing, at least for the time being.
Dean, you've been in the market for decades trying to analyze the economics of the moment. I would love your insight into how realistic we can be about some of the potential scenarios that are being priced into the bond market, with really Thursday night being thought of as a watershed moment, really looking for the potential for a Republican sweep and the idea of some of the fiscal policies, as well as tariffs, et cetera, put into place. Is that something that you are gaming out actively and think is a bettable type of option?
I think we always want to be thinking about all of the various scenarios, and markets will try to price in what might happen. But ultimately, from my experience, markets don't really fully price things in until the market is pretty sure it's going to happen. So we might see the scenario shift back and forth multiple times in the next several months before it finally settles on what truly is going to happen.
Hey, gents, this was great. Dean Mackey of Point 72 in Ligon BMO going into Chairman Powell at 9:30 Eastern before we get that first sniff, that scent of the jobs data this week when we get the JOLTS job openings at 10 a.m. Eastern time. Equities right now on the screen, negative by 0.4% on the S&P 500, about 43 minutes away from the opening bell. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, you'd mentioned this. President Biden is teaming up with Senator Bernie Sanders in a joint op-ed in USA Today. The two are taking on drug prices, writing this. Let's be clear, it's not just Congress that needs to act. Prescription drug...
Let's be clear, Joe Biden did not contribute to writing that.
Drug makers Novo Nordisk and Eli Lilly are called out by name. The letter also goes on to say that the Biden administration is working on legislation to expand Medicare's negotiations on drug prices. A check on Rivian shares pre-market for you. They're up 1.2%. The EV maker reported second quarter deliveries just above estimates, while it also reaffirmed its guidance for annual production of 57,000 vehicles. Analysts are now waiting deliveries from Tesla due this morning. Bloomberg estimates that the company delivered 440,000 or thereabouts vehicles in the second quarter. That's a drop of 5.8% from a year ago. And the U.S. men's national soccer team has had an earlier than expected exit in the Copa America, failing to qualify for the knockout rounds after a 1-0 loss to Uruguay. The tournament hosts entered last night's match tied on points with Panama in Group C, but their loss, coupled with Panama's 3-1 win over Bolivia, saw the U.S. knocked out. The tournament continues tonight with Brazil meeting Colombia at 9 p.m. Eastern. And that's your brief, John.
Danny, thank you. Thanks for this morning. If I ask you both, how many people in this country do you think know that is being hosted in this country right now? That some of the best football players on the planet are in the United States?
I would say I'm biased, and I am not able to answer that because I am surrounded by people who might have other interests.
I don't think that they've done a very good job.
Boring.
Dr. Ian Implants for Life was actually from one of my clients. You know, I've been having teeth problems for years now, and
oh my God, I don't want to see that.
19 sales numbers, those pre-pandemic sales numbers. And then for General Motors, we will hear from them today. General Motors, the sales are expected to be up 1.2% versus the second quarter of last year. And Tesla, might be today, might be tomorrow. Sometime we will get the Q2 sales numbers from Tesla. The estimate is
supposed to be today, but all right, we'll see.
Vehicles to be delivered in the quarter. That would be a 6.5% decline. By the way, the China numbers have already come out, and they were down 24.2% in June for Tesla. And as you take a look at shares of Tesla, remember, we usually find out once they report deliveries when they're going to be also reporting their Q2 financials, which are expected later this month. And then, guys, the big reveal that everybody is focused on, August 8th. That's when we will get details from Elon Musk regarding his plans for a robo-taxi. Guys, I'll send it back to you.
Okay, Phil, thank you. For more on this, we want to bring in Mark Fields. He is the former Ford president and CEO. He's also a CNBC contributor, and he serves on the boards of both Hertz and Qualcomm. Mark, let's run through a few things, right? First of all, what do you think about the health of the consumer right now when it comes to the car business?
Well, I think the health of the consumer is still relatively good. But, you know, Becky, what you're seeing is issues around high interest rates, issues around affordability. And that's why, you know, when we look at the first half numbers of this year, it's going to be up slightly versus last year. And yet you have to have some small impact from the CDK issue. But if you step back and look at the broader market, you know, it's slow growth for this year. As prices start coming down, as affordability increases, you'll see higher sales. But I think that the consumer right now, you're getting a normalization. The payments, monthly payments for car payments are stabilizing. Interest rates, discount rates from the automakers are kind of normalizing post-COVID. So relatively okay, but the industry has slow growth, and that's not a bad thing when you think about the overall state of the industry.
If interest rates don't come down and you don't get any more flexibility in terms of those loan rates, will that be a problem for automakers that have been kind of counting on it?
Well, it will be a problem. As you heard from Phil, if you look at inventory levels, they're up about 50% versus last year. And they're about normal levels right now, Becky, about 3 million units. And that's about normal for this time of year. So if you see consumers, not really kind of stepping up, the automaker is going to face a very important decision. They're either going to have to layer in more discounts to move those units and keep their plants running, or they're going to have to take the difficult decision of maybe reducing production, taking some shifts off, et cetera, which has, much bigger impact.
In other words, you need some rate cuts at the autos to help the autos along. Also, interesting note here, stock investors are struggling to find positive catalysts given the uncertain outlook for economic growth and interest rates in the second half. In other words, stocks might not have a safety net for the second half, especially as you go into the election season where people get a little more uncertain.
How big of a deal is that, just in terms of, I can't believe that they're still trying to get things back up and running. Hopefully in the next few days that will happen. But the idea that this could take down so many of them.
Well, this system, it affects about 50% of the dealers here in the U.S. And I saw a piece of data the other day that said the software that goes through CDK here in the U.S. represents about 2.6% of the GDP. So, as you know, the auto industry has a big impact on the GDP, but this system is the heart of these dealerships. It allows them to make their...
I still can't believe they haven't fixed the hack yet, or come to some sort of negotiated solution with that hack. There's a lot of dealers who just rely on this software, a dealer management software, for all their purchases and service orders. It's I couldn't imagine trying to get it all to paper, and how hard it must be to actually order the right stock without some software. But it'll certainly motivate some companies to say, that's it, we're gonna make our own software. Kind of like what we're doing at House Hack. We're like, yeah, your software's cool, but we don't trust you, so we're gonna make our own. Like, yes, we will do it our way. Okay, dokie. T.S. Lombard has a piece out this morning suggesting that you should be prepared for a July quote-unquote cut. Now, what could they possibly mean with a July quote-unquote cut? The economy is probably least important in the minds of Americans these days, and the Fed's aim is to keep it that way. Data continues to lower the rules-based Fed funds rate. Yeah, that's sort of like the economy cracking, like we're seeing, and some of the data starting to come in a wee bit softer. Yes, just a wee bit. As Kathy Wood says, the cracks are here. To be clear, the Fed has reason to be wary of current low inflation as it echoes the year-ago slowdown in growth. The economy picked up in the second half last year, creating many reasons to believe the current inflation rates are at a low point, not a stop on the way to pre-COVID inflation. One should respect how real growth has continued and the equity market has eked out gains. Okay, let's see here. Nevertheless, a recession is not an option. Inverted yield curve and negative real growth in bank lending augur for slower growth as the year progresses. We already know that. All right, so far all we got is slower growth. So the Taylor rule here, adjusted by them, sets the inflation target at 2.5%. Given these models, a 25 basis point cut in September, announced in July, is prescribed. Now that's really interesting. I hadn't really been thinking about when the Fed would start pre-announcing their rate cut. Let's see when the next Fed meeting is. Let's see here. Fed, I think Jerome Powell talks today. Oh yeah, what time does he speak today? We'll look at that too. July 31st. July 31, FOMC. Okay, so what about the schedule of them speaking? Let's see here. Federal Reserve calendar. Here we go. Here we go. Jerome Powell. Oh, 6:30 a.m. Right the moment the market opens. Oh, interesting. So that's Powell speaking in with Sarah Eisen at the European Central Bank Forum on central banking. So that'll start in 33 minutes, right as the market opens. And then our next FOMC meeting isn't until July 31st. So I'll write that down. Fed catalysts. FOMC, July 3-1. And today, ECB discussion. No, well, is it the European Central Bank? It's, yeah, at the European Central Bank. Forum on central bank. Forum on central banking. With Sarah Eisen. Jerome Powell will be there. Okay, today at 6:30 a.m. Well, so, yeah, 6. Wait a sec. 6:30, is that what that said? Yeah, 6:30. Alright. Right at market open. Ah, what timing. Alright, cool. Fed will take notice with a June jump in unemployment. Oh, okay. So that's what they're suggesting. So T.S. Lombard suggests the Fed may announce a September cut in July following weekend employment data this week. Remember, we get a jobs report this week. On Friday, we get the jobs report. Sarah trumps anyone else. Yes. Yeah, people still talking about my red lint. Alright, so inflation story is more mixed than the headline suggests. Yes, PCE only have 2.2 year over year, but it's good deflation driving the result. Service inflation, ex housing and energy, is still driving or still moving past 3%, though it's decelerated in the past 2 months. Problem is that goods deflation is no longer as strong. Expectations of where inflation goes next are a gamut. So in other words, we have no idea. All right, big deal. The economy today is not heading into a recession, but there are cracks, notably in housing. Hey, sounds very Kathy Woodian. The cracks are here. Okay. The announcement comes at the end of July, but it can wait. Better lower coupon yields with communication to boost housing and equities. All right, well, we'll see. We'll see what Tesla numbers must be out because it's going up. Stock's up about 2% right now. It was down about 2%. I don't actually see them just yet. But no, the stock's only up. Oh, stock's now going negative. Stock is dude, this stuff is moving like crazy. Why don't I have the freaking numbers yet? Now it's up 50 basis points. Now it's up 1%. Oh, here we go. Oh, second quarter 411. Oh, that's really low. Really, really low. So deliveries come in at 411,000. Production also slowed, 386 versus the 386,576. The stock's going up on bad numbers. That's hilarious. Okay, so but these numbers are bad. Deliveries 411,000. Oh wow, 386,576. That's down 11.83% and 19.41%. Holy smokers, that ain't no jokers. All right, I'm posting that on Twitter too. So in second quarter, we produced approximately 411,000 vehicles. Oops. Let me edit that around. We produced 411,000. Wait. And delivered, oh no, delivered 440. Oh, wait, this is confusing as anything. Hold on a sec. Let's fix this. Why is this coming through so weird? In the second quarter, oh, there we go. Oh, okay. They produced 411,000. And they actually delivered 444, which is above estimates. That's why it's going up. That makes a lot of sense. Okay, that's down 7 point. So the deliveries on the 444, I don't know why that was so hard to read. It's because of the Model Y units. Model 3, Model Y production was 386. Okay, there we go. We produced approximately 411,000. 411,000 produced. And that would be a decline of 14% on production. But the deliveries, again, 444, which is also a decline of 4.75%, isn't as bad as expected. Hence, the stock is now up about 2.3%. There we go. Okay. So that makes sense. That's so interesting. Okay. So now we have the real numbers, and it makes sense why the stock is going up. That's pretty good. I think that basically beat all of the estimates. So pretty good. There we go. Okay, now we can properly post that. There we go. Okay, so interesting how they break out these other vehicles here. Makes it a little confusing, but kind of cool. All right, so again, 443,956, negative 4.76% on deliveries, and production was 411. So about 30,000 fewer than they actually sold. There we go. And then if we go to, let's see here, if we go to Tesla, their actual press release here on it. Let's see if their press release is out. Yep, July 2nd press release is right here. Here you can see their actual press release. The exact number on production is 410,831. And let's see, Tesla will post its financial results on July 23rd. So mark your calendar for July 23rd. That was another date people were looking for.
Investor community as well as this real focus on the presidential election following the debate, what that means for the deficit in particular, and what that means for the 10-year. And I think that's partially responsible for that 20 basis point move we saw just in 2 days of that 10-year yield ticking higher. I think the focus has been kind of on what
Tesla's up like 4% now. It's almost at 220. That's crazy.
Clear consensus, but the one certainty that is out there in the macro environment does seem to be that the election will encompass more spending. And with all this talk about, Biden being the presumptive Democratic nominee, will they ultimately replace him? No one's talking about what all of these potential replacements would mean for deficit spending, although presumably that is also more of the same. So all in all, regardless of the outcome, you're looking at a higher deficit and additional spending in this environment where I believe, and Wilfred would be a better person to speak on this, it's kind of ubiquitous across the world right now with so many elections taking place and so much political uncertainty. And
Stock's now up about 4.5%.
As it pertains to what's going on in Europe and the election.
What I think is going to be really interesting after all of these elections, whether it's the French getting to next week, UK come Friday, US come November, is whether there's a reality check once we're out of campaign mode. No one's campaigning in this world today where politicians can get away with not necessarily nailing down precisely what their policies will be, and they kind of don't speak the truth all the time. No one's going to say, I'm going to massively hike taxes and cut spending. There probably will be a bit of a reality check for all of these countries in the coming years, whether it's forced on them by the markets, like Liz Truss experienced in the most pronounced way. If it's not quite as quick as that, it's over time. So we'll see what happens on that. I think the really interesting swing factor on the US, and it goes straight to the big elephant in the room on the markets and Nvidia, is trade relations with China. I mean, there was a big difference when Trump came in the first time, where nobody had really talked about tariffs and being tough on China, whereas you could even argue the Biden administration's been much tougher on China than Trump was, who was kind of more talk and less action. And might things actually not necessarily ease under Donald Trump, but not get tighter still than they already are? And that equation at the moment is really helping Nvidia. They've got the perfect scenario of demand is off the charts and supply is constrained in a way that, yeah, they're way ahead of the rest in terms of innovation, but there's also protectionism on that particular subsector like there's no tomorrow. So it'd be interesting to see, in fact, if that changes in a way that the market's not currently expected. It's sort of, most people think, oh, Trump's obviously going to be tougher on China. I also think Europe's interesting to watch on China at the moment, kind of following the US's lead. Could that ease a little bit? So we'll see. Just in terms of yesterday, David, you said wasn't a bad day yesterday. It was a really strong afternoon with no clear kind of reason or catalyst why after a soft morning, and another record close for the Nasdaq. Of course, you get those when you're up and around these levels, but not something to sort of ignore altogether.
No. And back to the budget, I mean, it will be interesting to see if we continue to have some sort of focus on it in the bond markets as we approach perhaps as soon as next year, I guess, interest costs exceeding those of allocations towards defense, which
I think we're
students
there,
of history,
aren't we?
we're very close. The students of history will say is always a bad sign for an empire, ultimately. And they'll go back.
That's what Ray Dalio would say.
They'll go back to Rome. They'll go back, you can go back to all of it.
Empire's a good word to use.
I mean, you guys had it as well.
After the SCOTUS decision yesterday. I mean, Empire's an interesting
Yeah, that they also have on their website here 9.4 gigawatts of energy storage deployment. And batteries are typically your highest margin. So I'm going to compare to Q1. It's almost twice what they did in Q1. That's pretty wild. That's pretty good.
At a much higher rate. Yeah.
So there might be a forced decision in terms of spending once we get past elections.
Yeah, I think we're already at $1 trillion a year in debt payments. Breaking news on Tesla. Let's get to Phil LeBeau.
Got the Q2 delivery numbers for Tesla, and these are better than expected. Remember, the street was expecting about 436,000 vehicles delivered worldwide in the second quarter. Tesla delivering 443,956 vehicles in the second quarter. 95% of them, as it usually is, Model 3 and Model Y. And so this is much better than was expected. Production coming in at 411,000 vehicles. 831 to be exact. So again, the reason you're seeing shares move higher, this is a better than expected number for the second quarter. Earlier today, we got Tesla's China numbers, and that had a few people a little bit nervous. Remember, China is the world's largest EV market, and therefore you want to watch it closely because it's such a big part of Tesla's overall sales around the world. In June, sales totaled 71,007 vehicles, down 24% year over year. For the second quarter, Tesla is in China, a little over 200,000 vehicles delivered. And I want to show you where Tesla is relative to BYD, because BYD's Q1 sales of electric vehicles, we're not talking hybrids, pure electric vehicles, so you can compare those with Tesla. They came in at 426,000 vehicles. So Tesla still remains number one worldwide. And there you see VW, GM, and Geely as well. And in terms of annual sales, I'll be curious what this does to the estimate of what analysts are expecting for the full year. Right now, it's come down to 1.82 million vehicles expected to be delivered this year by Tesla. For a point of reference, it was 1.81 million last year. So essentially flat. Do analysts now say, okay, maybe we're starting to see some momentum here. Maybe we raise the full year delivery estimate. Now, as you take a look at shares of Tesla, a couple of important dates to keep in mind. July.
Oh, look at that. Look at that. It's turning right at my line. Right at my line. It's the 221. I've been shouting out that 221 line forever on Tesla. Forever. I've been saying, watch 221 in July. It came a lot earlier than I expected. I will say I was expecting it to come like by the third week of July, but I've been kind of tweeting like, oh, watch this happen. 221 line by, July or whatever. It's July 2nd. Here you go. It's like an early Christmas present. That's cool.
Deliveries from Tesla.
Just quickly, Phil, better than expected by 4,000 or so, and obviously still marks another quarter
8,000, yeah.
Sorry, 8,000. My maths is off, or our estimates on the bottom of the screen are off a little bit. But talk me through that outlook. Even with a better quarter, even with perhaps things improving a little bit in the second half of the year, yet we're still stepping back, talking about flat year over year. I mean, do people think that that's a temporary?
If we come in at 1.82, it would be flat year over year. That is correct.
Well, whether it's 1.83 or 4, or we're not talking about growth.
Roughly speaking.
Do people?
I just went to Tesla's latest financial statement, and I used the gross profit from Q1 from the energy division of $403 million for Q1. And then if you multiply that by about 2.32, the energy storage deployed in Q2 versus Q1, you end up getting to $935 million contributed to the Tesla's bottom line. Wow.
Stock is undervalued. Energy storage is a great example. As Tesla continues to rapidly increase its energy storage deployments, people are saying that's what you should be focused on, not on vehicles. But make no mistake, vehicle deliveries is still what people generally focus on when they're looking at Tesla. And Wilf, to get back to your question, yeah, it's going to be flat year over year. This is why Elon Musk is pivoting, as he mentioned at the end of Q1, to a lower priced model. Now, how much lower priced will it be than the current Model 3? That remains to be seen. What can they do? I mean, they made an announcement saying, by early next year, maybe even late this year, which nobody's really buying into, you will start to see us produce and roll out a lower priced model. Are you tweaking the Model 3? How much lower priced can you get? They know. Tesla knows. The world is focused on a lower priced vehicle. They are not focused on the Cybertruck. That is a niche vehicle. And that's the issue, is that Tesla spent so much time on the Cybertruck when so much focus should have been, many believe, on a lower priced vehicle being developed.
Phil, real quick, the BYD numbers, give them to me again. Those were worldwide deliveries for BYD. What were they?
Yeah, 426 for the second quarter. So
okay,
and that's pure electric vehicles, David. Remember, BYD also makes a ton of hybrids. Pure electric 426, Tesla 444.
Got it. Interesting. Phil, thank you. Phil LeBeau. Well, coming up, Paramount is this morning's top performer on the S&P 500. We'll give you the latest on that.
Nobody cares about Paramount. We care about Tesla. It's now testing that 221 line. Pretty big deal right here. 221 is, let's get rid of this right here. 221 sitting, we're basically right at that test point right now. You got two critical lines here. I don't really remember, 221's a fib. I don't really remember where this orange line is from. It's like a 224 line or something like that. These are pretty big. The next stop is 258. So you break these and it's going to 258. Really impressive move there, Tesla. So great job. That's 2 days in a row now of 6%, then 5%, which then makes you wonder, like, who leaked the data a day early, right? Like, how many people did people, who knew of these beats, right? Mostly as consensus sort of kept falling, and it makes sense in a quarter where you had not only exceptionally low Tesla stock volatility, which was really an indicator that Tesla stock was about to explode, which we made a video about, we talked about on live streams, talked about in the course member live streams as well. But also, it was an indicator that we may have hit peak bearishness for the company, which is really great that is now behind. All right, let's listen in and see what we've got over at the Doombugs.
Fraud suit basically saying that he committed securities fraud of some sort in terms of his quote-unquote pump and dump GameStop scheme. That has now been dropped.
Oh yeah, that got dismissed like right away, that lawsuit. They probably got too much hate. So what trades is everyone making at the open? Who's going calls? Who's going puts? What's everyone doing?
Desire to create a bad sense around Keith Gill. And then finally, Paramount up 3.5%. Barry Diller perhaps entering into the race to explore a bid for Paramount. Yet another story there. This keeps on giving.
All right, so the allegation of frauds rescinded there. Very interesting stuff. Abigail Doolittle with a little technical analysis as well. We got to get those charts, Abby. Coming up, Tesla deliveries beat expectations. We'll take a look at the EV giant next. It's selling all 3s and Ys. No X's and S's. This is Bloomberg.
Nice. All right. Good. There we go.
In particular for the queer community.
Oh, everyone's on commercial. All right. All right, we're now sitting on the 221 line. Wow, look at that. That's pretty exciting. Got some dollar hollas flowing in to the Tesla. It's pretty good. All right, so next up we have J-Pow in 13 minutes. We have Jerome Powell. He'll be talking in 13 minutes over at the ECB conference on central banking. That'll be with, like, you know, your Christine Lagarde and some others. So we'll cover that. And let's see here. It looks like... Yeah, this is being broadcast from Portugal. So we're waiting for the next session right now. I've got the stream handy and am waiting for it, but it is not live just yet. Let's see how other things are moving in the pre-market here. You've got NVIDIA moving down about 177%. Tesla's obviously up 5.5 here after some smashing numbers. 62.8 here on BTCs. You've got Apple at 35 basis points. The Q's sitting at 35 basis points. Let's remove some of this stuff. There we go. Okay, Enphase. You know, if Tesla's deploying the storage, it is. It'd make you think that Enphase would be moving. But it's not. Yeah, look at the long-term trend on Tesla. Yeah, so the longer-term trend is this big orange line here. Let me see here. Oh, that's where we are now. Oh, that's the 224 line. Ah, it looks flat over here on the day chart. That orange line is the 3-year long downtrend for Tesla. Holy crap. On the week chart, it's not as perfect, I notice here. So I wonder if I move it. I might move it a little bit. Can I adjust it a little? No, it's not really easy. I guess like that. There we go. That would be a little better. So I wonder where that place is. I mean, it doesn't really matter. It is what it is. Okay, so that's the week chart. Let me look on the day chart now to see how that aligns. It doesn't hit. See, on the day chart, it doesn't hit if I do that. No, I gotta stay where I was. So let's grab it again here. Come on, buddy. Ay. Let's replace this. Oh my lord. Come here. It's not that hard. There we go. Yeah, see, that's more of a match. Just sort of hit these lines a little better. It's not perfect. You know, I could grab the middle hit, or I could hit roughly here, somewhere around here. It's certainly not perfect by any means. But I get a nice triple hit over here. Oops. Definitely didn't want to do that. That's okay. I can adjust that pretty quickly. For 14 and 50. And then let's grab our bottom to make sure our fibbies. You know, it's always a good idea to lock these suckers. 101.81. There we go. Doing this with the coffee in my hand. 101.81. Yep, that's perfect. Okay, so I'm going to lock that one. Alright, now I'm going to lock the orange one too. There we go. Alright. So now, this looks a little better. There we go. There's our longer downtrend. If I take it down to the minute, it moves it up a little. Somewhere here in the 220s is basically where you hit that long-term downtrend. All right. Very well. Let's listen in over here for a moment. Why Paramount?
That might allow people to start thinking about doing if that were to happen. And then finally, you've also got these talks that CNBC.com reported on yesterday between Warner Brothers Discovery and Paramount about basically putting Paramount Plus into Max, into HBO, or Max, it's not called HBO, and giving some sort of economic stake to Paramount and having it be a global offering. So there's that as well.
So I was going to ask a little bit about Warner, because you mentioned them there. Clearly, we don't know how close the Dilla deal is, but the Skydance deal got pretty close.
Yes.
Where then was the trigger to bring in some of these more bigger traditional media players that we've always wondered, oh, they'll wait to see what's happening, but they won't want to miss out on one of these deals?
Well, I mean, I think if you're Warner Brothers Discovery, despite what would be the presence of enormous potential cost synergies, billions of them, it's the antitrust concern. You're simply not going to be either. You're going to fight a year and a half, at which point you're going to watch a lot of that value start to evaporate over that period of time. So when you close the deal, the synergies that were available to you are no longer anywhere near what they were. And I think that's the case for our parent company as well. These are tough deals to imagine doing that could change if, in fact, we get a change in the administration.
But Warner's restricted for various reasons. It's not like they're soaring at the moment. They've got a lot of debt already themselves. For Comcast, our parent company, Disney, Netflix, this is
a little boring. I was hoping they'd have something interesting to talk about. So looking at the overall direction of the market right now, you got Rivian with some beats. It moved up on news of the beats. Obviously nowhere near the beat that Tesla had. You've got the Qs are crawling up in the pre-market here. Apple's trying to crawl up. NVIDIA is actually trying to crawl down, and so is AMD. So you're getting a little bit of a slowdown in that chip sector. It's possible people are taking their money out of the chippy dudes and throwing some more of it into Tesla. That's just a speculative assumption, of course. So we don't know that with certainty. You've got Affirm, Adobe, Palantir, Hims, Chipotle, Arm, and Birkenstock moving down a little bit. Celsius. Goog's over here at 25. Let's see the big movers right now. If I go pre-market, obviously Tesla's at the top, which is great. Did drop a little bit at that 222 level. It was over 6%. Now it's sitting at about 5.7. You know, big deal, nominal difference. Trend's clearly up here. CrowdStrike at 221 to the downside. NVIDIA is actually at 169 to the downside, along with ARM. So almost all of the chips moving down here today. Palantir at 76. Looking at Plug Power, we're at 132 to the upside, up there with Rivian, and of course Tesla's the one kicking butt right now. Getting some red candles here, 5 minutes to go. Some of that pre-market enthusiasm might fade. That's okay. We'll see how the day actually opens for Tesla. All right, so let's go into the Doomburger. Doomburger! And they're on commercial. Come on! Everybody's on commercial! All right, next up, so we have that session with J Powell begins in 4.5 minutes. Less than 4.5 minutes. Steepening in the Treasury yield curve may have started. The yield curve has steepened as of late. Yep, we've been watching that for about the last 6 days now. Long end Treasury yields have shot up more than 15 basis points since last week's presidential debate. Possibly hurt Joe Biden's chances of winning re-election. Victory for rival Donald Trump is stoking fears of fiscal expansion, bringing bond vigilantes out of the woodwork. That's fair. Seems too premature to know what policies other candidates might unveil, be it Trump or otherwise. Blah, blah, blah. Okay, that's all boring. I am curious to see if we've gotten some new polls. Ooh, there are some new polls. Let's look at the polls. Powell stream in 4 minutes. Yes, I know. Oh, look at that. You actually have a poll here. I&I tip poll suggesting Biden has a 2% lead. Now, when did they conduct that? Was that done before or after? Oh. It was both before and after. The national poll answered by 1,200 voters. So relatively small sample size if you took a lot of those people and surveyed them on the day of the 26th and the day of the 27th. So 33% of this data could have been pre-debate. Or sorry, 67% of that data could have been pre-debate. I want to know what's going on with the when they, how many votes they did after they took after the debate. The debate literally asked who would win the debate, as if it hasn't happened yet. Yeah, so this is a dated poll. Okay, so that's nonsense. That's a pretty dated poll. What about this one? Okay. Debate. Let's see here. %17% of those surveyed said they might change their minds. That's a lot. I mean, you lose your swing voter, right? So, it's gonna be wild. All right. So, Jolt's numbers come out in about 30 minutes. JPO comes out with market open here. So we'll see what happens with Market Open. Market opens in about 1 minute. Q's trying to push up. Apple's trying to push up. Nvidia's pushing down. A little bit of a sell-off there on Nvidia that's trying to continue. So we'll see what happens there. And yeah, let's listen in. Here we got about 30 seconds to go.
Upping their target on the S&P to 5,700 from 5,300. But interesting period of time we're at where on the top line of their raise note, they say this is a nervous raise. And then there's all sorts of caveats in the opening page about why they're kind of doing it reluctantly. And that does sort of speak to the moment in time that we're getting to.
Nonetheless, stocks the best performing asset class in the first half of the year. 83rd percentile gain for the first half. So I think now the question is just, does that momentum continue, or do you feel like recent weekends potentially dropping out and helping them come higher?
The opening bell. Here's the New York Stock Exchange. Take a look at the real-time exchange. That's what our headquarters. Here's the big board, the Goddard merger report. 3. That's a SPAC. Celebrating its recent listing.
JPOW is not out yet. We're keeping an eye on that, though.
Charging company. Didn't mean to interrupt you there, Leslie. If you want to finish your point.
You said SPACs, EV charging company? Is it 2020?
Amazon's falling, and as the Qs are trying to rise.
Company. But yeah, SPACs are still sort of with us.
They are. They didn't
vaguely. They didn't completely go away.
But they're not, here in the way that they were back then.
No. And there are different reporting requirements at this point. You're not seeing any of those long-term free cash flow estimates that made absolutely no sense, but could be put into writing at least, and help promote the stocks at the time.
Those were fun times, though. But speaking of the capital markets, we did get some interesting moves in the banks.
Well, the banks, just to mention, by the way, a lot of the smaller banks are topping the S&P this morning.
Still waiting for JPOW here, and we do have Jolts coming out in about 29 minutes.
So a lot of the smaller banks up about 1% or so as we take in these first minute or so of trade.
In a negative tape, Raymond James upgrading Comerica and First Citizen bank shares. And part of the thinking here, we also saw Seaport Research upgrading Bank of America on these potential tailwinds. And we're having this
Nvidia starting to green candles.
have served time on the banking beat, by the way, which is kind of a really special
you too, yes, for
place
at least
to be.
the last, decade at CNBC, right? I would say.
Both of us were just trying to fill your shoes, Dave.
I don't, I never considered myself a banking reporter,
Banking
but we did not
tangential.
have one for many
J
years.
Pow's thing is starting to do some like intro video here, but nothing new yet. Tesla's down at about 4.2 right now. I mean, up at 4.2. It's pretty good. Nvidia's trying to recover.
And this is, by the way, the Seaport upgrade on Bank of America. It has a similar theme to the Lori Calvasina upgrade to the S&P.
Yes.
It's a reluctant upgrade.
Yes.
And, again, I look at all of this, Leslie.
Qs are moving up really nicely. And Nvidia's recovering.
Even though it's not my beat anymore, I kind of find it hard not to read everything that comes across in London about the US banks. But Bank of America's back up to $40. I mean, it got down to 25.
And
these aren't cheap stocks at the moment.
No, and a big reason why they had such an overhang, especially last year and early this year, was because of the whole balance sheet issue and all the underwater securities. And investors were really punishing the stock as a result of that. Now with this upgrade, and some of the thinking is kind of coming around to this idea.
Nice. Good job, Alice, holding on to those Nvidia puts from yesterday. That's awesome.
In their earnings.
Tesla's losing its edge here. I don't know why the market feels a little bearish today, honestly. Little bearish here. These are really good numbers. Nvidia's got a little bit of bearishness going on right now. Tesla a little bit of bearishness. I'm not saying it's going to last. I'm just saying it's what we got right now.
That we talk about all the time. And so a lot of investors are expecting some kind of inflection point this year for net interest income, especially for those banks who are more tilted toward
and not as concerned
over-earning
any
on
longer
NII.
about some of the long-dated assets in the balance sheet,
That
which, of
was
course, during the banking crisis. Okay. It's starting, I'm told in my ear. That means the ECB forum. Let's go to Portugal and Sarah Eisen.
Our host from the European Central Bank, and President Campos Neto from Brazil. This time last year, when we were all talking, you guys were in the sort of final process of hiking rates. Fast forward 1 year, and now it's interesting. While I'm going to miss Governor Ueda and his jokes, we've got three great panelists here going at different speeds, I would say, when it comes to reversing that course. So would love to just open it up, President Lagarde, with you and ask, where are you in this process? Because you cut in June, so now what?
Well, it's been a journey. You can't just say, oh, we cut in June. It's coming on the back of a period of hikes, which was unprecedented, facing shocks that I tried to describe yesterday over dinner, and followed by a period during which we held rates untouched, and during which we were restrictive enough to actually see our medium-term target reach that 2%, which is our objective. And most recently, we have seen in our round of projections, which are really important, September, December, March, and June, we've seen that 2% target with an oscillation of 0.1 about it at the last quarter of 2025. So it's on that basis, and on the basis of what I'm happy to describe as, the three-leg reaction function, and all the underlying data and information that feeds those three legs, that we decided to do a 25 basis points cuts. But in the same breath of air, I also said that it was not a linear process, that it was not a predetermined path that we were embarking upon, but a step that would be followed by further review of data, further understanding of where our three legs reaction function would be. So that's pretty much where we are, and I would simply maybe add...
There's Powell! Powie wowie! Hey, Powie!
That disinflationary path, and we are in that sort of slow recovery, which came about during the first quarter, and which we hope will persevere, but all of that is flawed with uncertainties and big question mark about the future.
Sounds like you're setting up the market for a pause now. Is that right?
I'm not setting up anything for, anyone. I think that it's for everyone to really look under the skin of the economy and see where it's heading, and appreciating what our reaction function is and how we're likely to decide.
Chair Powell, you have also been on a journey and have been on hold since last July, have not cut rates like the ECB in June. Why not? What are you waiting for?
So let me say that sitting here last year, there was a lot we didn't know, and we didn't know that we were just about to embark on a period of 7 months of much lower inflation readings. We didn't realize that the second half of last year was going to be an extraordinary year from a growth standpoint, and also from the standpoint of the labor market. So things actually worked out in the second half of last year in a remarkable way. Then, as you know, in the first quarter of this year, we continue to have solid growth in the first half, actually, solid growth, and a labor market that's still strong, although we've seen a continued rebalancing in the labor market. And inflation, after pausing
Tesla's breaking 221, let's go!
Resuming its disinflationary trend. So it's a little bit different journey. So where that leaves us is we've made quite a bit of progress in bringing inflation back down to our target. While the labor market has remained strong and growth has continued, we want that process to continue. I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. That's what we've said. And what we'd like to see is more data like what we've been seeing recently. We'd also like to see the labor market remain strong. We've said that if we saw the labor
Qs are going green on this.
Unexpectedly weakening, that is also something that could call for a reaction.
How much more confident do you want to be?
Qs are going green on this. Nvidia's going green on this.
That wasn't too bad that we got last week.
That's right. So we're actually on a 12-month basis. We're actually at 2.6, both headline and core for inflation, and that represents really significant progress. I think we peaked at 5.4% in core, and the same thing has happened in headline. We've gone from 7.1 to 2.6. So yes, we've made a lot of progress. We just want to understand that the levels that we're seeing are a true reading on what is actually happening with underlying inflation. And as we were saying at the last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation which was well above 3%. So we want to be more confident, and frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right. And that's what we're planning to do.
So September?
I'm not going to be landing on any specific dates here today. Let me also say that we're well aware that if we go too soon, that we could undo the good work we've done in bringing down inflation, and if we go too late, we could unnecessarily undermine the recession, the recovery, and the expansion, and so we're aware that we have two-sided risks now, more so than we did a year ago. That's a big change. I'd say risks are coming much more into balance now.
President Campos, you have been on a different journey because you've actually been cutting.
Okay, so risks more in balance than last year. Okay, all right.
Recently paused. Why?
BTC's kind of moving up on this. So are the Qs.
And what are you going to do next?
Okay, so if you go back a little bit in the history of time, so Brazil was one of the first countries to hike rates. I think in part because we had a different call on the dynamics of inflation, both locally and globally, and I think that turned out to be correct.
Enphase is popping on those storage numbers, yes.
The easing cycle. And throughout this process of easing, we've seen that inflation has converged. We have some of the problems that are common to advanced economies and other Latin American countries, which is labor markets very strong. So there were 2 points of attention. One was labor market being that strong, would that at some point in time mean inflation in the service side? And even though we haven't seen that yet, what we try to do is to try to estimate what would be the components of labor in every service so that we can anticipate if that were to happen. We haven't seen it, but we think it's, there is somewhat of a correlation when you look at the margin. And so most recently we decided to pause. That had to do not only with the current numbers and with this suspicion that we had service inflation that could peak at some point in time, and also because food prices we're going back up a little bit, and I also think that's not only happening in Brazil, it's going to happen in some other places too. But also has to do with a lot of noises that we had. So we decided to interrupt the cycle. More recently, we've had a sell-off in some of the emerging market countries. Brazil was more affected. But I think this has to do much more with noises that were created than the fundamentals. And the noises are related to two channels. One is the expectation on the path of fiscal policy, and the other one is expectation on the future of monetary policy. So when you had these two at the same time, I think it created uncertainty enough that for...
Good upturn, by the way, on Bitcoin right now. Nvidia's moving up. We've got Amazon's looks like it tried to find a bottom there. Apple got rejected by 217. The Qs are now up 10 basis points. That's a big move on the Qs, moving up nicely on the Qs here. That's pretty good. Tesla's trying to test its 221, really trying to get a breakthrough there. AMD is now up 2% out of nowhere. AMD just started running. Meta's moving up. DJT's moving up. Enphase is moving up. Robinhood's moving up. Coinbase is moving up. Frankly, everything is just moving up right now. Supermicro Computer's moving up 1%. You've got Adobe moving up $1.25 here. So some pretty bullish moves overall today, and an initial reaction there from Jay Powell, pretty bullish. Looks like you've got Nvidia now only down 1.21%. I think a lot of shorts are starting to freak out a little, eh?
Services are still above 4%. So what is keeping prices so sticky?
Well, first of all, we had, as you said, a number that was lower than last month. So we said it was bumpy, and it's heading in the right direction for the indicator that we use, which is HICP, to measure inflation and to set our target. So
right, if we measured inflation that way, we'd already be well under 2%.
It's likely to be a bumpy road until the end of 2024, but we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front. You are correct that services hasn't budged. So services is at 4.1, if I remember from the numbers that we got this morning. And obviously we are very attentive to the components and what is behind services. And the real issue is to understand whether those are this is caused by sort of permanent changes, or whether it is also a factor of the lag effects of other components which are finding their way more slowly and gradually into services. And the jury is out as to exactly what it is. The truth of the matter is that we do have a service number that has gone slightly up in the recent months, and which is now staying at this 4.
Tesla breaking through 221. Here we go.
Now, obviously, we don't need to have services at 2% because manufacturing goods are below 2%, and at the end of the day, it's going to be a balance between goods and services, and it depends on the weight of those within the index. But we have to look really what is behind it, and what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe, where clearly bargaining agreements are negotiated not only on an annual basis in some countries, but sometimes on a triennial basis in other countries. So you have this catch-up effect. You know, for those people whose renegotiation took place early this year, they had not had a negotiation of wages in the last 3 years. In the meantime, of course, inflation went up and their real wages went down. So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window and services are also going to be on a declining path as well. But services is the
recovery kind of keeps going there on NVIDIA as well.
I was just going to pose that Taylor Swift is touring Europe this summer, and there tends to be an inflationary effect in services. Am I right, Chair Powell? We saw it last year, didn't we?
It's not just Taylor Swift, others have come as well. Larry Spring.
I don't know. I saw her at Wembley, and there was a lot of spending going on. No, but how do you look at the services, the stickiness of the services inflation?
Sarah's jokes aren't landing on Taylor there. I liked it.
Which have been rising.
Famously, services inflation is stickier, and famously it's tied to wages. I would say, so look at the U.S. labor market. We've seen a pretty substantial move toward better balance than we had a couple of years ago when labor was in extreme shortage. So what you see now is an unemployment rate that's moving back up toward a more sustainable level. You see wage increases moving back down toward a sustainable level of wage increases, inflation, and productivity. And you see vacancies to unemployment ratio coming back to where it was pre-pandemic, and so many other measures I could mention. So that's what we're seeing. And so the labor market, wage increases are still a bit above where they would wind up in equilibrium, but nonetheless, you can see the labor market is cooling off, appropriately so, and we're watching it very carefully. But it doesn't look like it's heating up or presenting a big problem for inflation going forward. Indeed, it looks like it's doing just what you would want it to do, which is to cool off over time, not quickly, not suddenly, not steeply. It's kind of what we've been hoping to see and have been seeing. So, and services generally they're such a mixed bag, particularly non-housing services are a mixed bag. Some of what you're seeing is catch-up inflation from inflationary pressures that happened earlier. That's true with insurance. It's also true with housing services inflation, where you've got some pent-up rent increases that have to work their way off. It turns out it takes more than 1 year for that to happen. It takes several years. So we see all that in train.
Tesla's full breaking above 221 now. It's above 222. Let's go.
This year or next year, or maybe late next year, but in the year after. The main thing is we're making real progress.
Can you keep cutting President Lagarde if he keeps holding?
Blame him.
Does it make it harder?
Well, look, I'm going to give you the conventional response because that's the conventional question you ask me. We do take into account the spillover impact of whatever is decided by other esteemed colleagues. And obviously, my esteemed friend, Chair Powell, is one of those. So we take that into account, but we also determine our monetary policy on the basis of what we see in our economy. And we look at the data that we get, the impact that multiple factors have on our economies and its numbers.
Does it matter for you, President Campos, what the Fed does next?
Well, I think it matters to an extent, but I think there is one point that is worth mentioning, which is more recently we've seen a sell-off in some of the EM, and especially the EM that had more. There were more the best cases for investment. And you see that this is being explained with local news. But when you have a lot of sell-offs in different markets and they're all explained by local news, you have to ask yourself if there is a more fundamental factor driving that. And I think there might be. It's difficult to make the case right now, but definitely what we see now is there is more risk premium in a lot of the emerging market countries. And it was very synchronized with the long end of the US curve, and that correlation broke. So we've seen the last couple of weeks that even though the 10-year yield is more or less stable, even actually going a little bit lower, we saw a bit of a sell-off in emerging market countries. And I think that has to do with the fact that as you go for longer with higher rates and much higher debt, you start extracting liquidity from the market, and eventually you are repricing that liquidity. It could just be a temporary adjustment in EM, or it could be the beginning of a more profound movement. We need to wait and see. But I think the correlation between the US Treasury and some of the EM has been broken in the last couple of weeks. And I think we should pay attention to that.
What about the fundamentals in emerging markets? Because the economies seem to do better during this hiking cycle than they have previously. Why do you think that is? And does it continue?
I think most EMs did a better job in terms of, or at least an equal job in terms of anticipating the process and starting the hiking process. Also in the fiscal part, on average, emerging market countries spent more or less 10% of GDP facing the pandemic. Advanced economies spend a little bit more than 20. So I think there is also this thing which didn't happen in the past, which is by and large, emerging markets were able to deal with the pandemic spending less. And actually, when you look at the fiscal post-pandemic, emerging market continues, it's not the case of every country, but continues to do a little bit better. So I think that also change the dynamics. And one of the things is, I think, the independence of the central bank and the maturity that a lot of the central banks have gained in emerging market proved to be very useful during this process of the pandemic.
Some quick notes that I'm just watching in the market right now. So I'm watching the Qs top out right here. So this is a little bit of a warning. I didn't hear J Powell say anything bad here, but I'm watching the Qs top out a little bit. I'm watching BTC top out a little bit, all within the last about 7-8 minutes. I watched Nvidia top out a little bit. Tesla keeps going, which is good. Little on the low momentum side, so you do have a risk of a big red candle there. But so far, so good. But those are some things that I'm watching right now as I'm listening to this event.
We do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings, and now a slight softening in unemployment. In the form of wages, you see demand coming down, not just the supply that we're getting, but also demand coming down. You also see the effects of high interest rates in the housing market and in some other interest rate sensitive things. So you see that, and I do think that restrictive policy is working hand in hand with this broad supply side recovery we've had, where we've seen the unwinding of the shortages and bottlenecks from the pandemic. We've also seen a recovery in labor force participation among prime age individuals in the U.S., and then some immigration, which has also been a positive supply shock. So we've seen all those things work together to give us, really significant declines in inflation. At the same time, we've got a strong labor market and growth. This was it's a great outcome for the people that we serve, and it's one that we want to do everything we can to foster.
So why not just cut rates to protect it?
It's what I said earlier.
Is it a bigger risk? I'll rephrase. Is it a bigger risk that you cut prematurely and inflation stays sticky, or that you wait too long and the economy loses more momentum?
That is the question, and our answer to the question is we serve a dual mandate, right? And these two things are embodied in that mandate. The risk on the inflation side is that you move too quickly, inflation comes back, and we didn't really solve the problem. And then we have to go back in, and that would be very disruptive to the economy. So the other risk is that we wait too long. We understand that, and the labor market softens too much. Perhaps we lose the expansion. So needless to say, we don't want to do that either. But at the same time, we've got to balance those two. And again, given the strength we see in the U.S. economy, we can approach that question carefully. But as I said earlier, though, you see a year or so ago, we were talking about inflation, and our framework called for us to focus on the variable, the mandate that is further from its goal. They've come back much closer into balance. And a good way to see it is the beverage curve analysis that everybody talks about and looks at. We've come straight down the beverage curve, which you're really getting to that place relative to job openings and hiring rates, where traditionally the beverage curve is flattened out, which would mean higher unemployment as a result of further declines in job openings. So you can't know that with precision, but it's very much understood by us that we have two-sided risks and we have to manage them.
What about the recovery in the Eurozone, President Lagarde? It's also been pretty resilient, especially on the unemployment front. How confident do you feel in sticking this soft landing?
Well, we reached a level of confidence back in June when we decided to actually cut rates by 25 basis points. But as I said in the opening remarks, it's not something that is taken for granted, that is a given. And we're going to re-examine each and every step of the way whether that confidence is actually continuously reinforced in order to continue on that path. And the remarks by Chair Powell made me really reinforce my points about data, because we are navigating in this universe of one risk versus the other.
I'm a little watching this market again. Bitcoin just gave another little red candle here. We got the JOLTS data coming out in about 3 minutes, okay? Remember, we're going to want ideally a number that's under 8, but not so far under 8 that it's recessionary. So you want to be like 7.7 or 7.8, somewhere around there.
Of wages, whether it's the sort of on-time data or not, all of that has to be taken into account and analyzed in details so that we can feel really confident that we can go forward.
At the same time, there are also political risks. Certainly they're front and center. It was nice of all the authorities to make elections all happen this week, certainly in France and in England. President Lagarde, is there anything the ECB can do to shield the rest of the Eurozone from feeling any negative impact from a divided government in France or from whatever the result is of the French election in a negative way?
I thank you so much for your question.
It can't be a surprise.
Because I'm not going to comment on the political situation of any of the member states, particularly those that are facing elections at the moment. But, obviously, the European Central Bank has to do what it has to do. Our mandate is price stability. Price stability is obviously relying on financial stability, and we are attentive to that because this is part of our job, and we will continue to do so.
Does the rise in French bond yields look worrisome at all?
These are the things that we monitor. This is part of the job. It's not particularly at this point in time. We do that.
Yeah, it's impossible that Sarah Eisen pisses everyone off. It's not possible. She doesn't piss me off.
Hard for the central bank's independence in Brazil, and yet now you are the subject of many attacks from President Lula, and so I'm wondering how you're dealing with that.
Attacks from me?
No. No, President Campos. Attacks from President Lula. I think he called you an adversary and an enemy.
Yes, well, I think as a central banker, we have to get away from the political arena and try to...
About 1 minute to JOLTS. I'll read it out when it comes in. Things have kind of topped out a little bit right now. BTC topped out, though it's trying to recover. Q's topped out, also trying to recover. Nvidia topped out, trying to recover. Tesla topped out, trying to recover.
In his last year of mandate, we increased rates in a cycle that went from 2% to 13.75%. That's the biggest increase in rates in an election year in the history of any emerging markets. So if that is not a proof that you are independent and you acted autonomously, it's difficult to find another example like that. So I think all this narrative that the central bank has been political, I think we have to get away from that and explain what we're doing. And I think what we're doing has been very technical. The last decision was unanimous, and we now have 4 members in the board that were chosen by the current president. And I think what we need to separate it was what is the political narrative and what is the technical job that we need to do. And I think history will tell and time will tell that the job was done in the best we could do with the data that we had at hand, and that was in the most technical way, and it was done in a group of people that actually analyzed all the data and that worked very...
It comes in a little hot. 8,140,000, so a little less desirable for rate cut enthusiasm.
Yeah.
Any advice for him? You've been through some attacks from
I have no advice. I will say, though, to put it in my words, we've been given this great responsibility and great powers, and really important that we get it right. And we've been told to stay out of politics.
Prior was revised down by about 100K, though, so it's pretty much at expectations.
We don't try to get involved in issues that are not our issues, and in particular, we're just focused on our goals and getting through that. And if we do that and do it well, I will say in the United States, there's very broad support for an independent Fed in both political parties on both sides of Capitol Hill and everywhere. I don't think that's really in question, as long as we just are seen to be doing our job and staying on task at all times.
Can I say something?
Yes, please.
I think that there are countries where governors do exactly what Chair Powell said, and yet get blamed, criticized, and I think that for some it takes courage to do the job in addition to being a good, excellent technical expert.
But I do wonder if you're concerned, because your term ends, President Campos, at the end of the year, and it doesn't seem like President Lula is going to reappoint you. So do you worry about the independence of the central bank?
So first, I was never up for reappointment, regardless of who won the elections, and I've said that from the very beginning. When I helped design the independence law, I actually tried not to have the reappointment possibility in the law. And for me, the reason was I didn't want that the president of the central bank, at any circumstance, would have any incentives to bend his knee in order to have any kind of re-election. So that we need to make that very clear. Secondly, there is actually a risk premium down in the curve, and I think it has been elevated in the last couple of weeks as to an uncertainty of what happens when the next leadership or the next team takes place. But this in Brazil is done very slowly because the president can change 2 directors every year, and we have 8 directors plus the president. So right now we have 4 directors that were appointed by the current government. And the last monetary decision was unanimous. So I think what we did in the last decisions proved that the group is very cohesive in trying to find a technical solution for the country. So I understand there is a risk premium and there is always this uncertainty, but I think the group that we have, which is composed of 8 directors plus a governor, voted unanimously, understanding that that was the best for the country at that time. And so I understand that there is a risk premium, but I think with time that risk premium will tend to decrease.
There are concerns in the United States about Fed independence if President Trump gets elected. There have been reports that he's looking at that issue. Obviously, you've been subject of attacks before. What is your level of concern about that?
I am not focused on that at all. And that's not just a talking point. I really think that we just keep doing our jobs. I mean, the U.S. economy, we have 4% unemployment. It's growing at 2%. Inflation's at 2.6%. Let's keep that going. Let's do our jobs. History will judge. I think if we can keep things on that path, that's what I'm focused on. That's the only thing I'm focused on. And as I mentioned, I do think support for the Fed's independence is very high, where it really matters on Capitol Hill in both political parties, among the leaders and most of the following. And so I worry about getting the job right. That's what I worry about.
I know you guys don't want to touch politics, but President Lagarde, it does bring into focus the fiscal policies, right? We heard President Campos say it. There are concerns about the deficits in France, if the far right should win. There are concerns in the United States about the deficits. So I do wonder if you have something to say or to warn on the fiscal front as it relates to making your inflation fight harder.
Well, fiscal matters enormously, true, and it matters in 2 different ways from my perspective. It matters from a sort of conjunctural type of way, and thank goodness the European authorities have agreed on the fiscal governance that will take over after the Growth and Stability Pact has been has been suspended and now completely replaced. So there is a framework within which members of the European Union have to operate, have to control the direction of their debt, have to make sure that it is sustainable going forward.
I think she said debt, but it sounded like dead.
Have to keep their deficit on watch with enough flexibility, and that's the second part of fiscal spending that I'm concerned about, with sufficient of an impact of a focus on productivity, on growth, of investment that will be conducive to both. And my hope is that in addition to operating within the European fiscal framework, which has been agreed by all European members, in addition to that, countries will actually look at the structural changes that they have to either continue to have in their arsenal of tools, but also that they will continue to improve going forward, because I regard that as critically important for productivity purposes, which we are lagging behind and have been lagging behind for a long time. So
NVIDIA somewhat bleeding here, by the way.
Expectations, as Roberto was saying, for Brazil or emerging market economies, but we're very concerned about the fiscal rules that have to be respected.
So is Bitcoin.
Within the European Union, and the structural reforms that will be conducive, hopefully, to productivity improvement going forward, because that's the only way for Europe to actually...
Yeah, productivity gets you out of debt and out of recessionary dynamics. Worth also noting, AMD basically gave up its entire run.
And transformations that we have talked about.
And I know you're allergic to fiscal policy, Chair Powell, but I have heard you talk about the unsustainable debt burden of the United States. And even lately, there's been a sell-off in treasuries after increasing odds that President Trump will be reelected, that there might be a sweep of either party. Doesn't that make you nervous when it comes to the progress you've had on inflation if we do see more expansionary fiscal policy, more deficit, bigger deficits, bigger debt loads?
So I'm going to give you the traditional answer to some extent, and that is that we just know fiscal policy is a job for elected people. We're not elected people, so we don't comment on it, and particularly in advance of a presidential election, we're not commenting on anyone's particular policies one way or the other. I will say more broadly, though, the United States is running a very large deficit at a time when we're at full employment, and it just is, the level of debt that we have is not unsustainable. The path that we're on is unsustainable. That's completely non-controversial. I would have thought that this is something that should be a top-level issue, and you do hear this from a lot of elected officials, but it should be a real focus going forward, is how do we get back to a sustainable path, because you can't run these kinds of deficits in good economic times for very long. I mean, I wouldn't say, I can't really speak to the time, but in the longer run, we'll have to do something sooner or later, and sooner will be better than later.
President Campos?
Yeah, let's do a basic exercise. If you look at the total debt combined, just sovereign debt of US plus Europe plus Japan, that's 64% of the total global debt. That went, in terms of cost of servicing that debt, it went from 1.2% before the pandemic to around 3.3% right now. But then you added 25% of GDP to that debt, which was the cost of facing the pandemic. So we have a much higher debt and a much, much higher cost of service the debt. So I think there is an aspect globally that is the extraction of liquidity that cumulative will have an effect in the market that sometimes is not pricing correctly. And if you think about what we have to do right now, we have to pay for the cost of the transfer programs that we did. We need to pay for the cost of the green transition, which is somewhat expensive. We need to pay for the cost of the fragmentation, which you look at the surveys and it's very costly for companies and for governments. We need to pay for the cost of the low-income countries that spent very little during the pandemic and now need support. We need to pay for the cost of demographics. And there is a surge in consumption of energy that needs to be paid because of the innovation. So we have a lot of bills to pay. We are at the highest level of debt that we had in a long time. And I think it's sometimes I stop and I think it's time for us globally to think about a way to get to some kind of stable trajectory of the debt in the next couple of years. And it's not one country or the other. It's something that we need to do collectively because the global debt is very high and it's going to start taking a lot of liquidity from the markets. And the ones that will feel the effect are not the advanced economies, are the emerging economies, emerging market economies. And the low-income countries are feeling that effect already.
And you think the market is mispricing this risk?
I think the market was mispricing a little bit the fact that if you have higher rates for longer, the effect from extracting liquidity, depending on how much longer you're going to have these higher rates, I think the risk is higher than what the market is pricing as.
I also wanted to ask you, President Campos, about China, because you have a pretty good view. It's such a big trading partner for you. What's going on there? How much is China's economy slowing?
I'm not sure I'm very equipped to tell you what's happening in China. I can tell you that is very important for a lot of emerging market economies. It's very important for Brazil. We are a very big exporter of food items and iron ore. So China is a very big trade partner with Brazil. And it has been for a while. And regardless of the government, it's important to understand that is a very important tie to Brazil. The one thing that we look from looking from far away is we're trying to see what are the policies that China is doing, what is the focus, and what is the impact that this new policy will have for us. But because we export mainly food items and iron ore, we don't see that as a big threat. I think some other countries will have a different understanding of what this impact will be.
Yeah, I mean, there's also trade barriers that are going up. President Lagarde, tariffs. I mean, in our election, we're talking about potentially more tariffs. Are you seeing that in terms of growth and inflationary impact?
Well, we're not seeing yet more tariffs than what had been decided back, 8 years ago, and which was consistently maintained later on in relation to certain products. So that for the moment is stable. What is not stable at all is the number of protective measures, occasionally non-compliance with WTO rules, the level of disputes that are brought before the WTO, which is not in a position to resolve them because they are not equipped with the dispute resolution mechanism, and magistrates have not been appointed to that effect. We've had more than 3,000 trade protective measures decided in the last 2 years. And that is like 5 times what is the normal average of measures that are decided. So that's a concern. And it's a concern because trade has been fueling growth, and because Europe at large is not a small open economy, it's a large open economy. And trade restrictions are going to affect Europe much more so than other countries that operate without this degree of opening and vulnerability in a way. But the second reason I'm concerned about it is that typically trade is conducive to innovation. Innovation is necessary for productivity. And I think that the combination of reduced trade on growth and the impact of trade on the capacity to innovate and to improve productivity is a vulnerability for Europe, and one that we have to address very forcefully if we want to win this battle of productivity. So and it's not independent from inflation. I'm not getting away from my topic, but it's one that is clearly a concern on the horizon.
But and it could be inflationary. I mean, 10% across the board tariffs, Chair Powell, inflationary?
Of course, I'm not going to be scoring any potential political proposals which have been talked about. It's just not our job to do that. Also, almost anything affects the economy. Trade affects the economy, immigration, energy policy. Those are not our jobs. There are other agencies that do those jobs. We do maximum employment, price stability. So in our political economy, we stay out of that.
But it has implications for price stability, surely, and maximum employment.
Again, we're not looking to be. This is exactly what we're not looking to do, which is to become players on issues like tariffs. I mean, because it affects. I mean, literally everything. All these things affect inflation and jobs. But notwithstanding that, there are others in the elected government who are responsible for trade policy. We don't comment. That's all.
Understood. So back to your job then. There is this debate and among the Fed and other central bankers about where policy rates are going. R-starred, the neutral rate, what that rate should look like, and whether it's different after COVID. What do you think?
Can we go back to trade?
Yeah, sure. Please.
He just hates the fiscal questions.
I guess I would start by saying that the thing that we write down as part of our summary of economic projections, and the thing that economists mean by R-stars, is a longer run concept. It's the rate of interest that would hold the economy at equilibrium at a time when we're at stable prices and maximum employment and there are no shocks hitting the economy. So this is not the economy today. So the first thing to say is that when we're sitting in the boardroom in Washington thinking about whether our policy rate is the appropriate rate for this economy right now, we're not battling over what long-run R-star is, because this is a different economy. This is an economy that's still recovering from the pandemic. And so many forces are pushing it this way and that way, and there's really not a lot of precedent, so it's a very challenging time. But it's not, the question, the R-star question is a really interesting question, and that is, are we going to go back to the very low levels of neutral rates that we had in the recovery of the global financial crisis, or are we going to go part of the way back from today's high rates to that? And intuitively, most people think that we won't go back to those very, very low rates that we saw, during the global financial crisis recovery period. But we don't really know. I mean, the neutral rate has moved around, we think, by slow-moving, longer-run forces, demographics, technology, productivity over time, all of those things move it around. Ultimately, the balance between savings and investment. So it's a great conversation to have. But honestly, when we're looking at policy in the boardroom, it's how is our policy affecting today's economy, and do we think we're getting the results that we want? And by and large, in a world where this isn't a world of precision, we think we are. We're getting a gradually cooling economy, a gradually cooling labor market, progress on inflation, 4% unemployment, 2% growth. We're getting kind of what we would want to have. And so that's, I worry that some people, no one in this room, but some people think that the R-star debate is the thing that dictates our assessment of how restrictive policy is. It's really not. Unless you think that the long-run rate is the same as today's rate.
I think that investors are trying to figure out, though, where you're going to end up and what the policy path looks like once you start cutting rates. And it becomes important then.
No, I agree. It does. Yeah. It's what will we discover to be? We'll find it empirically. What will we discover it to be? And I think there's a debate going on. There are people who feel very strongly that it hasn't changed and that it has changed. And ultimately, it's unknowable. It does matter for the longer run. It matters for where rates will settle out, but it doesn't matter much for policy decisions today, which are the ones we're actually making.
I guess we want to know if there are like 10 cuts coming or 15 cuts. I mean, do you think, President Campos, it's changed post-COVID? Are you dealing with a different economy?
So the R-star story for emerging market countries is a little bit different. So, for example, if you had a table of countries of Latin America, you would find that at least the models internally used by their own central banks.
I feel like markets are kind of like waiting for this to be done because BTC is not really happy about this. 62.2 right now, not great.
What is the short-term view and what is the long-term view, as Chairman Jay described? And I think for us it's more like trying to understand what is the structural reason for the neutral rate in Brazil to be so high, 4.5% real time, is really high. And I think a lot of it has a lot of structural elements from the past, but it has intensified during the pandemic. And you could go and talk about the amount of subsidized credit, you can talk about the trajectory of the debt, you can talk about productivity. For example, when you look at productivity, there is one thing that not a lot of people talk about, which is in the need for raising money, sometimes the adjustment is done on the revenue side. When you do the adjustment on the revenue side, if you look at what's being done in emerging market countries and even in some advanced economies, you tend to go back and tax capital more than labor, because it's very hard to tax labor coming out of a pandemic. If you tax more capital than labor, and this has already been happening for a while now globally and especially in emerging market, then you introduce another element that will bring productivity lower. So when you look at the causes of the neutral rate to be so high structurally, that's, I think, what we need to work on. And Brazil has done a lot of reforms. We have done reforms. And I think if you compare to other EM countries, Brazil was actually able to do reforms in the middle of the pandemic. We did the social security reform, we are doing a tax reform, we did the labor reform, all in the middle of the pandemic. But still, when you look at the efficiency of what was done, the end result seems to be that our structural rate is still our neutral rate, our star is too high. Mm-hmm. And I think we need to go on and talk about what are the reforms that are needed in the medium term to make sure that we have a structural rate, a neutral rate that is lower than we have right now.
President Lagarde, do you ever see a world where we get back to near zero interest rates absent a crisis?
Do I think we're heading towards that? That's, in my view at this point in time, it's very unlikely, but it's not something that I would want to pass judgment on. What I can tell you is that when we start having that conversation that Chair Powell described perfectly well and that I would completely subscribe to, I would be relieved, because it would mean that we are getting closer to where we need to be. It would mean that we do not have any shock suffered by the economy, nor on the immediate horizon. So that would be good news. But we are certainly not at this stage, and this is not the work that we do when we set our policies going forward.
One thing that's been moving fast and has the potential to impact economies is generative AI. And I know we started talking about it a little bit.
Oh, we're going on to the AI discussion with the central bankers.
Things have moved, President Lagarde. So how are you thinking about any impact on growth or productivity or inflation of what's happening in technology?
Why, Sarah, that's a subject for which we need another hour, because there's so many questions about it. Number one, there has to be some regulatory framework within which AI and generative AI in particular, especially if it's in the hands of a small oligopoly of companies, is actually organized in order to protect a number of rights and protection of citizens. I would start from that, which is not where we are for the moment, although there are attempts to organize in a better way, as was the case with internet, on a global basis, the use of generative AI. So point number one. Point number two, and I will let Roberto talk to that point because he's more of an expert than I am, the question of how much energy is used in order to test large language models is really something that is not often in discussion, and yet it matters enormously. Third, the impact that AI will have on growth, on inflation, on productivity, I think is yet to be determined. I think most people would agree that it will have an impact throughout the ladder of jobs in most segments of the economy, in areas where mechanical developments have not historically affected jobs in particular. And it will require significant amount of training and constant upskilling of people so that they can adjust to artificial intelligence, use it, and not be victims of it. I would add to that I think we at the ECB are using artificial intelligence, try to do it in a safe environment without being hostage to those companies that would like to have access to the most private of our data. So it does require a cautious management and enough control without preventing the innovation and the creativity that people can apply in the use of these tools.
You use it in models? How do you use it?
We use it in models. We use it in, whenever we need a lot of language mining, and whether it's structured or unstructured data, for that matter, we use it, and we are constantly pushing the frontiers of that. But as I said, cautiously, because we need to protect data, and we need to make sure that there is enough human judgment involved in the process of this use of artificial intelligence, so that we are not either hostage to the mechanics itself.
Do you think that fears over generative AI, Chair Powell, rendering certain jobs or industries absolute, are legit? And is
obsolete?
The central bank can do?
I don't think we know. So you see this massive investment boom. You see, serious people in the private sector and the public sector. There's a sense of something big coming here. And it feels like what that will be is it will eliminate some jobs, it will create some new jobs. And the question really is for many people who will it augment their labor and make them more productive, or will it eliminate their job? And I just don't think we know that. It's too early to say. There's not a lot a central bank can do about that. This is really a job for. We can supervise our financial institutions and things like that to make sure that that they understand what they're doing with all different kinds of technology. But also, like everybody else, we're meeting with all the experts and asking ourselves what will be the effects on productivity, on inflation, on growth, and will it be enormously displacing, and if so, of whom? One thought is that it'll be more people doing white collar jobs who are writing press releases and things like that. So We just don't know. It's something we're investing a lot of time and effort. We're not using generative AI. We're very carefully looking at that. Other earlier forms of AI are in fairly common use in American business, and I believe we use some of that.
What about you, President Campos? I know you're focused on the energy needs as well.
Well, first, I think when you look at the surveys that we have, and we have plenty now on the use of AI on companies, what you have in terms of empirical evidence up to date is that the companies that use AI to enhance existing labor have had better results than companies that have replaced labor for AI. So that's something that we know. It doesn't mean that some jobs won't be replaced by others, as it was said. But I think what we need to understand is what we are seeing basically is an increase in the ability of processing data and storing data. So it's basically computer power and the ability to data. And that's very energy consuming. You have a couple of dimensions that you need to look in. You look to privacy, where is the limit, and what is the taxonomy of using this once it becomes a global instrument? What is the taxonomy of using this? Because you could be talking about data centers being placed in countries that have cheap energy to produce services for countries that have more expensive energy. So once you start crossing the frontiers, thinking about how you're going to do this movement globally, I think there's a lot of consequences. And one of which I think is you're going to have very unequal growth between the countries that are more on the edge of producing this technology and the countries that are not. And the energy consumption also will be very unequal. So I think globally we need to look at how we're going to connect the dots and create more or less a taxonomy for this development to be sustainable.
In the minutes that we have left, want to do sort of a quick...
It's almost over. That's a good sign.
Of questions.
I think the market's just going to pump. As soon as this freaking event is over, I think it just moons.
About economies. What about the biggest risk facing your economies? And I do wonder if they're the same or different. Chair Powell, what's the biggest risk facing the U.S. economy right now?
Yeah, I mean, I traditionally have said cyber risk to that because we know how to deal with credit risk. We know how to deal with lots of kinds of risk, market dysfunction, things like that. But we haven't really had a big successful cyber attack on a financial market utility or a bank. Good. And that's the kind of thing which I think is, the stuff of lying awake at night. I would also, today though, honestly, really it is just the balance that we talked about, getting the balance on monetary policy right during this critical period. That's really what I think about in the wee hours.
President Lagarde?
Same thing.
Really? Really? Cyber risk?
I think, I'm saying that touching wood, actually, and I wish, because it's one, if you
Okay, get him off the stage so we can rally. Come on, wrap this up.
With which we interact a lot, sometimes much to their chagrin, but eventually to their satisfaction in the long run, I'm sure, because we supervise them carefully. But typically, that's a risk that they flag as one of their top priority risk, and on which I think we need to constantly improve the level of coordination, first, second, third line of defense, and best way to respond to those. Now, clearly, I'm concerned as a person more than as president of the ECB about the backlash that there is against the fight against climate change, and some would argue that it has nothing to do with...
Okay, once we get into climate change, it's usually a good sign the event's over.
Actually, not the case. It does have a ramification impact that we should be mindful about, but it's a risk that is there and that will come to haunt us if we don't do much about it.
I thought you were going to say geopolitical risk. That's there too, right? Facing Europe?
Geopolitical risks as defined by
nice PP.
Maurizio earlier on. No, who was it?
Yeah, Moritz.
We heard a lot about geopolitical risk.
It's there, and it's just on the doorstep of Europe. When you look at this horrible war against Ukraine, it's a major risk which is out there and which is hurting those on the ground and the neighboring countries in particular.
What's your biggest risk?
If you look at what markets price today, they will probably at least for part of Yemen, especially for Brazil, the conclusion would clearly be that the main risk is fiscal. But I think that comes and goes, and it has to do with growth and productivity and a lot of the things. I think there is one other risk that I see, and it's not very tangible, which is the polarization that we live today. If we think about the amount of time that we spent on some social issues that are connected to polarization and that are not that meaningful to produce well-being of the society, I worry a lot about that.
Yeah. So if we're sitting here on stage in 1 year from now, which we hopefully are, the inflation rate in the U.S. will be
2%. Mid to low twos.
That's kind of, we're mid twos now.
Yeah. Well, we have 1 month at 2.6. And, we had a brief visit to the low twos at the end of, but I mean, sustainably, durably underlying inflation between 2 and 2.5 is what I would say. That would be a great outcome.
Headline PCE.
Yeah.
President Lagarde, 1 year from now?
1 year from now, I would say low twos. We are at 2.5 latest reading, and as I said, bumpy on the way ahead. But yeah, low twos.
You've been closer to 4%, President Campos, right, lately? So where do you think you are in a year from now?
Well, I won't be in the central bank a year from now.
We already established that. Yeah.
But I think that the work that's being done is very technical. I'm confident that we'll continue to be that way. And I think when you look at expected inflation today, I think it has a disconnect with the current inflation. And it has a disconnect with the fundamentals that we have in Brazil.
Disconnect?
So I'm confident that the future inflation will be lower than the expected inflation. In other words, I think what the market's pricing today is not in sync with the reality.
What about the unemployment rate? We're going to go full dot plot here.
Yeah. I'd be happy if it were just right where it is now. That would be a good outcome. Plus or minus a couple of tenths would be good.
Is that likely?
Yeah, I think it's reasonable.
Starting to rise.
It's moved up from 3.4. We touched 3.4, so we're up to 4. But 4 is still a very low level. It's been a long time since. The last time we were at 4 or below for this long is I was a teenager, a long time ago.
Also, unemployment rate in Europe, it's been what, healthy, 6.5%.
Historical low,
yeah.
And I hope it stays there a year from now.
What's the unemployment rate in Brazil?
Well, it's close to 7% now, which is very low when you look at our history. I think probably we'll go up a little bit, but not too much. But I think what we need to look at is the participation rate. So we just published a study that shows that the transfer programs have an impact in the participation rate. Our participation rate was down and then it's recovering a little bit at the margin. And I think it would be very important to understand what is the dynamics of the participation rate going further.
And finally, Chair Powell, were you a 2-cut dot or a 1-cut dot for 2024?
No comment.
Thank you very much, all of you,
Thank
for
you.
participating. I tried.
She did.
All right, that was ours.
Okay, event over. Very good. So hopefully this is just a freemium opportunity now for the market to rally. I don't know. I'm going to take off. We'll see. I'm going to press my little disclaimer here. Thank you all for being here. I love y'all. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. There you go. I'm going to make some more coffee and we'll head on over to a course member live stream. We'll see y'all soon. Thank you so much for being here. Really